Assalamualaikum warahmatullahi wabarakatuh. We are from Group 1. Today we will present about audit of the capital acquisition and repayment cycle. My name is Siti Nur Izzamiti Zalmi. Firstly, I will start with the introduction of this chapter. So basically, the capital acquisition and repayment cycle involves activities related to obtaining funds through debt or equity and repaying tax obligations. This includes process such as issue the shares, obtain the loans, paying the interest, and distributing the dividends. These transactions are crucial because they provide the financial resources a company needs to operate and grow. So, this cycle is important to ensure that all transactions are properly authorized, accurately recorded, and adequately disclosed in the financial statements. Errors and misstatements in this cycle can mislead stakeholders about the company's financial stability and compliance with legal or contractual obligations. The auditor focused on key areas like proper documentation, authorization, and reconciliation to confirm that the company has managed its finance responsibly. So next, I will pass to next presenter.
Assalamualaikum, my name is Nur Shafina binti Ramli. Today I will present about the characteristic of the capital acquisition and repayment cycle. The capital acquisition and repayment cycle revolve around how company obtain and repay funds to finance their business. These funds may come from equity such as issuing share or debt like loans or bonds. The first key characteristic is that relatively few transactions affect the account balance, but each transaction is highly material. Unlike day-to-day operation in cycles like revenue or purchases, these cycles handle infrequent but significant events. For example, issuing share, obtaining loans, or making large capital investment. These transactions usually involve millions or even billions. This is important because of the financial size of each transaction. They directly and significantly impact the company's financial statement. For instance, let's say a company issue 50 millions in bonds. This single transaction could have a greater impact on the balance sheet than hundreds of smaller sales transactions combined. Second is the exclusion or misstatement of a single transaction can be material. This is because the transactions in this cycle are typically high in value. Unlike minor accounting error, even one omission or misstatement here can have a ripple effect across the financial statement. For instance, imagine a company repays a 10 million loan but fails to record it. This single error will lead to an overstated loan balance on the balance sheet and understated cash balance, as the cash outflow wasn't captured. And lastly, a legal relationship exists between the company and holders of share, bonds, and loans. This means that when a company issues share, shareholders gain right to dividends and voting. Similarly, issuing bonds or taking loans create a legal obligation to repay the money and make interest payment. For example, if a company issue 100 million in bonds, it must pay interest each year and repay the amount when the bonds mature. This transaction must be recorded correctly or it could lead to penalties or lawsuit. Next, we will explore an important concept in accounting, which is account in the cycle. These accounts are critical component of a company's financial system, helping to track liabilities, interest, and equity. First, we have notes payable. This account record the unpaid principal due on a formal written promise to pay. For example, loans from bank fall under this category. It's an essential liability account that helps businesses track their outstanding debt accurately. Next is a mortgage payable. This is a long-term liability representing the unpaid balance of a loan secured by real estate. What's important here is that the portion of the loan due within 12 months is reclassified as a current liability. This ensures accurate financial reporting of both short-term and long-term obligation. Next is a contract payable. Contract payable used when you have a large project involve contractor. It's vital to maintain detailed records beyond the payable report. This account helps track the amount owed to contractor efficiently, ensuring smooth project management. Now let's look at bonds payable. This is a form of long-term debt issued by corporation, governments, or hospital to raise funds. For example, government may issue bonds to finance infrastructure project or refinance old debt. These accounts are crucial for managing large-scale financing operation. Moving on, interest expense represent the cost of borrowing money. This is a non-operating expense, calculated as the interest rate times the outstanding principal. It applies to borrowing such as bonds, loans, or convertible debt. Next, accrued interest. Accrued interest reflects the interest that has accumulated on a debt since the last payment date but remains unpaid. It's typically recorded as a current liability and ensure proper tracking of short-term interest obligation. In this slide, I will continue other accounts that are part of the financial cycle. These include appropriation of retained earning. This refers to the profit set aside for specific purpose, such as restricting funds for future dividends. These appropriations are determined by the board of directors and help manage strategic financial planning. Next, treasury share. This represents the portion of a company's own share that it has repurchased or never issued to the public. These shares are held in the company's treasury and may be used for purposes like employee stock option or reducing share in circulation. It's typically recorded in the shareholders' equity. Next, cash in the bank. This is a straightforward account representing the total of all coins, currency, and other cash item deposit in a financial institution. This account ensures liquidity for daily operation and financial obligation. Next, dividend declare. Dividend declare refers to the situation where a company has announced a dividend payments to its shareholders, but the actual payment has not yet been distributed. This represents a liability for the company until the payment is made. Next, ordinary share. This represents equity instrument that is subordinate to all other equity classes. Shareholders owning ordinary share participate in the company's profit only after all other types of shares, such as preference share, have been accounted for. A key feature of ordinary share is their voting right, allowing shareholders to influence the company's decision. And preference shares. Preference shares are a type of equity where the shareholder receive dividend before ordinary shareholders. However, preference shareholders typically do not have voting right. This makes them an attractive investment for those looking for a steady income stream from dividend.
My name is Siti Nur Izami. Now, I will continue the part of account in the cycle. So the next point is donated capital. Donated capital is an asset given to a company, typically by government entities, to encourage them to operate within their areas. It is represent the fair market value of an asset recorded as a gift in the shareholders' equity. The next point is dividends payable. It is declared dividends by the board of directors that are owed to shareholders. So the next point is retained earnings. The accumulated profits of a company will reduce by dividends or other distributions made to investors. So next we move to other point, which is proprietorship capital account. It is a business type owned and managed by a single individual with no legal distinction between the owner and the business. It is the simplest form of business where the owner is personally liable for the company's debts. So the last point is partnership capital account. It is represent the equity in a partnership's financial records. It is reflect the contribution made by all partners agreed upon collectively towards the firm's permanent resources. Okay, next we move to methodology. In methodology, we have a three phase. In phase 1, the auditor will identify the client business risk will affecting notes payable. So, the auditor will look at the company's business environment and practice to figure out what could go wrong with their notes payable. For example, is it the client borrowing too much or not recording their debts correctly? So the second one is set tolerable misstatement and assess inherent risk for notes payable. So, the auditor will decide how much error in money terms is acceptable in the notes payable balance. Also, the auditor will evaluate how likely it is for errors to happen naturally, like mistakes in calculation or fraud. So, the last point is assess control risk for notes payable. So, the auditor will check the effectiveness of the company's internal controls. For example, are there proper checks in place to make sure notes payable are accurately recorded? So next we move to the second phase, which is testing, control and transaction. The first point is design and perform test of control. The auditor will test how well the company's system and procedure control are working to prevent or catch errors in notes payable. For instance, check if approval for loans or payments are being done correctly. So the second point is a substantive test of transaction. The auditor will check the actual transaction related to notes payable like loan agreements or payment to ensure they are recorded properly in the books. It is like verifying the paperwork match the financial records. We move to the last phase, which is analytical and detailed testing. The first point is design and perform analytic procedures. The auditor will use the comparison and calculations to see if the notes payable balance makes sense. For the example, the auditor will compare this year's balance with the last year's or with the similar company to spot any unusual difference. The second point is test the details of notes payable balance. The auditor will look at the specific notes payable items to ensure they meet the audit objective. They have a 4 items, which is the first one is audit procedures, the second one is sample size, the third one is items to select, and the last one is timing. Okay, that's all from me. Thank you.
Assalamualaikum. My name is Nur Najah binti Muhammad Safri. I will present about term loan. What is term loan? Term loan is a legal agreement where a borrower receives a lump sum of money from a lender with the promise to pay back the principal amount and interest over a specified period. There are two types of loan: secured loan and unsecured loan. Secured loan required an asset as collateral, while unsecured loan, no collateral is required. Loans are issued for a different purpose, and the property pledged as collateral include variety of assets. Example, first is securities. Securities is investments like stocks or bonds. Second is account receivable. These are the amount owed to the company by its customer for goods or services. Third is inventory. This refers to the goods a company has on hand for sale, such as raw materials, work in progress, or finished goods. And fourth is fixed assets. These are long-term assets like property, equipment, or machinery that are not easily converted to cash. This flexibility makes them adaptable to different business needs and risk profiles. Next is about the repayment structure. The principal and interest payments are usually structured according to the terms of loan agreement. The agreement will clearly define the amount of money borrowed, the interest rate charged, and the repayment schedule. For short-term loans, it's common to have a lump sum payment at the end of the term when the loan becomes due. However, for long-term loans for over 90 days, interest payments are usually required on a monthly or quarterly basis. Next, move to the objective of the audit of long-term liabilities. First, internal controls over long-term liabilities are adequate. Auditors need to assess the effectiveness of the company's internal controls related to long-term liabilities. These controls ensure that transactions are properly authorized, recorded, and reconciled. This includes procedures for authorizing and recording debt transactions, reconciling debt balances, and monitoring compliance with debt covenants. Strong internal control help ensure the accuracy and reliability of financial reporting. Second is transactions are properly authorized and recorded. Auditors examine whether all transactions involving long-term liabilities, such as borrowing money, making loan payments, and accruing interest, must be properly authorized and recorded. Proper authorization ensures that transactions are legitimate and aligned with company policies. Accurate recording ensures that all transactions are captured in the accounting records, preventing omissions or misstatements. Third is the related liabilities and expenses are properly stated. This objective focuses on the accuracy and completeness of the information presented in the financial statements regarding long-term liabilities and related expenses. Auditors aim to ensure that the company's financial statements accurately reflect the amount, timing, and nature of long-term obligations and related interest expenses. Auditor assess the company's ability to continue as a going concern considering its long-term debt obligation and other factors. Next is internal control that related to long-term liabilities. Internal control are the process and procedures that a company implement to safeguard its asset, ensure the accuracy of its financial reporting, and promote operational efficiency and effectiveness. First is proper authorization for the issue of new long-term liabilities to prevent unauthorized borrowing, which can lead to excessive debt and financial instability. The company must establish clear policies and procedures for approving new long-term liabilities. This typically involves a multi-level approval process, often requiring sign-off from senior management or the board of directors. Example, a company employee takes out a large loan without proper authorizations and approval of senior management can strain the company's finance and potential bankruptcy. Second is adequate controls over the repayment of principal and interest. The company must have robust controls in place to ensure timely and accurate repayment of principal and interest on its long-term liabilities. This includes establishing clear payment schedules, reconciling loan agreements with payment records, and maintaining sufficient cash reserve to meet debt obligations. Example, if company fails to reconcile loan agreements with payment records, leading to missed interest payments, this can result in penalties, increased interest rates, and damage to the company's credit rating. Third is proper documents and records. Maintaining accurate and complete documentation for all long-term liabilities is crucial. This includes loan agreements, amortization schedules, payment receipt, and any other relevant supporting documents. Proper record keeping helps ensure compliance with accounting standards and facilitates audits. Example, if company lost or misfiles critical loan agreements, this can lead to disputes with lenders, difficulty in resolving loan modifications, and potential legal issues if the company cannot prove the terms of its debt obligations. Lastly, predict independent verification. Regular independent verification of long-term liability balances and related transactions is important. This can be achieved through internal audits, external audits, or other forms of independent review. Verification helps identify and correct any errors or discrepancies in the company's debt management process. That's all from me. Thank you.
Hi, Assalamualaikum. My name is Putri Balkis binti Muhammad Roslan and I'm going to present about loan payable and related interest account. So for the figure that I included in the slide, it shows the account used for notes payable and related interest. Auditors commonly include test of principal and interest payment as a part of the audit of the acquisition and payment cycle because the payment are recorded in cash disbursement journal. But in many cases, because of their relative infrequency, no capital transactions are included in the auditor's sample for test of control and substantive test of transaction. Therefore, it is also normal to test this transaction as a part of the capital acquisition and repayment repayment cycle. Test of notes payable transaction involve the issue of notes and the repayment of principal and interest. These audit tests are a part of test of control and substantive test of transaction for cash receipt and cash disbursement. Additional tests of control and substantive tests of transaction are often done as a part of test of detail balance because of the maturity of individual transaction. In addition, auditors should verify the accurate recording of receipt and notes proceeds and payments of principal and interest. So next I'm going to explain a little bit about analytical procedures. Analytical procedures are essential for notes payable because tests of details for interest expense and accrued interest can often be eliminated when results are favorable. The auditor's independent prediction of interest expense using average notes payable, outstanding and average interest rates helps the auditor evaluate the reasonableness of interest expense and also for omitted notes payable. So the first analytical procedures, the example is what we do. We recalculate the expected interest expense using average interest rates and the loans amount. Why we do it is to check if the interest expense matches what it should be, and the possible issue there could be mistakes in interest calculation or missing loan. The second analytical procedure is what we do is compare individual loan amounts from this year to last year. Why we do it is to spot any unexpected changes or missing loans, and the possible issue is a loan might be left out or recorded incorrectly. And the last analytical procedure is what we do is compare the total loan balances, interest expenses and accrued interest to the previous year. Why we do it is to ensure consistency and identify unusual changes, and the possible issue is errors in interest expense, accrued interest and loan amounts. There is two important balance related audit objectives in loan payable. First one is completeness. Auditors need to make sure that all existing loans are included in financial statements. The reasons why, if any loans are left out, it could make the company look like it owes less than it actually does. The second, accuracy. Auditors check that the loans recorded are correct in terms of amounts, interest rate and details. The reasons why is because even small error can affect financial report and can lead to do a wrong decision. I'm going to explain a little bit about the schedule of notes payable and accrued interest. The first one is, as we can see, that it is for the XYZ company notes payable 31st December 2011. The first column is payee, first, second, third is National Bank. This is the one that we own money to. So the second column is date. It is made in due, and the due one is 1 year after the payment was made. And the next column is face amount of notes. It is the total face amount, and then it got security. It is a secured loans. As we can see, the description is investment and also fixed asset, which is collateral must higher than loans. So the valuation, the amount of valuation, and then also the balance at beginning of period. So the first row is the for previous year loan, and then the second and third is for current year loan. So as you can see at the top of it, we also got schedule and then prepared by, approved by, and also got the date at the right column. For the second figure, the first one is notes. The first column is addition. As we can see, it got like 10,000 for the second and third row, and then the second column is 10,000, which is the payment has been made. And then for the first column, it has 0 balance at end of period because the payment has been made. And the second and the third, it got for the balance at the end of the period lah. For the interest part, so the first one read 9.5%, and then it paid to maturity, accrued at beginning of period is 238, right? And then the expense 712. If we add the both of the amounts, we got 952, which is the total that has been paid, and then the accrued at the end of the period will be 0. And then for the second row is 10% maturity, and then the expense part is 250, and then it will be recorded as accrued at the end of the period because the payment has not been made. And the third row, 10% maturity, the expense part is 167, and it has not been paid, so it will be recorded as accrued at end of period, which is 167. So that's all from me. Thank you.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Nur Atira Bahia binti Muhammad Sabri. So I would like to explain about the honest equity. So I will touch 3 parts for honest equity. First thing, I would like to explain the comparison of honest equity between public listed and private limited company. The second one, I will touch about the objective of auditing the honest equity. And the last one is the relationship between honest equity and dividends. So we go the first one. So honest equity is representing the residual interest in the asset of a company after deducting the liabilities. So it is a critical aspect for the financial structure that providing insights into a company's capital, return earning, and overall financial health. So by understanding the differences between equity structure between public listed and private limited companies, it is essential for financial professional, especially auditors. So the first aspect that they are different in is shareholders. Public listed company tend to have many and diverse shareholders, while private limited company just have a few and closely associated. Regarding the transaction, the public listed company have more frequent trading, issuance, and buybacks compared to private limited company because the transaction happens occasionally and just a simple transaction. While the regulation, public listed company is stringent reporting and compliance to SC, Securities Commission, and private limited company has minimal external reporting. The next part is equity components. Capital return earnings and frequent dividends are the equity components for public listed company, while for private limited company, they just have similar structure but with a fewer complexities. And the last aspect is governance. For public listed company, they are managed by a board with a shareholder meetings. While private limited company often closely managed by the owners themselves. Because the next part I will explain is objective auditing for honest equity. The first one is adequacy of internal controls. It is to confirm the internal control over capital shares and dividends are adequate. This also includes ensuring the processes are in place to properly authorize, document, and verify transactions related to honest equity. The second one is correct recording of transaction. This is to ensure the owner equity transaction such as issuing or repurchasing shares and declaring dividends are recorded accurately and completely. in line with the 6 transaction-related audit objective. The third one is proper balance recording, which is to verify the honest equity balances are properly recorded in compliance with the 8 balance related audit objective. And this ensures that the balance are accurate, complete, and free from misstatement. So the last objective is appropriate presentation and disclosure to ensure the honest equity accounts are properly presented and disclosed in the financial statement. This includes clear reporting of shares, dividends, and retained earnings. So let's continue to the relationship between honest equity and dividend. So under the slides, it provide a detail of the flow and relationship between the honest equity and dividends. So the first one is if you can see the capital stock, it represent the par value of the issued share. So the transaction, when when the stock is issued, the capital stock and paid in capital will increase, and also cash in bank also increases. While if stock is redeemed, which is recorded as redemption of stock, the capital stock and paid in capital, capital stock, and cash in bank will be decreased. And the declaring dividend will reduces the retained earnings and creates a liability in dividend payable. And paying dividends reduces cash in bank and clears the liability in dividend payable. So the last part in honest equity that I would like to explain is about the audit concerns that have arise in honest equity. So the ultimate goal of this objective is to ensure the integrity, accuracy, and reliability of honest equity accounts. So with strong internal controls, rigorous auditing, and transparent disclosure, it will provide the stakeholder with a good company's financial reporting. So the audit concern for capital share would be to confirming the occurrence, completeness, accuracy, and proper disclosure of share issues or repurchase, and also to ensure records of shareholders are accurate and up to date. For dividends, the audit concern is to the validation that declare dividends are recorded and paid accurately, ensure the completeness, accuracy, and occurrence of dividend payables. And the last one for retained earnings, the review transaction affecting retained earnings such as net income or loss, dividends declared, and prior period adjustments. So these are the audit concerns that will be include while auditing the honest equity. That's all from me. Thank you.
Assalamualaikum, my name is Nura Ashakiri. So today I'm gonna present to you about honor equities internal control. So the first internal control is proper authorization of transactions. Approval by the board of directors is mandatory for significant equity transactions. So the 3 key transactions requiring authorization include is issuance of capital shares such as ordinary or preferred shares, number of share, par value, and issue date. Next is repurchase of capital share such as ordinary or preferred shares. And the third is declaration of dividends such as cash or share dividends and their terms. For example, if a company wants to issue 1,000 new shares to raise fund, the boards need to decide how many shares to issue, the value per share, and the timing. Similarly, for share buybacks or declaring dividends, like paying 1 ringgit per share as a cash dividend, the board must approve this decision to ensure proper governance. The second internal control is proper record keeping. Companies maintaining their own share transaction records must ensure this three, which is correct recognition of actual shareholders in records, accurate dividend payments to shareholders, and minimization of the risk of asset misappropriation. Also included is essential documents such as capital share certificate records and shareholders master file of capital shares. For instance, if a company has issued 10,000 shares, its records must show who owns them and how much each shareholder is owed in dividends. Key documents like share certificates and a shareholder master file help ensure that all shareholder details are correct, payments are accurate, and fraud is avoided. And lastly, the third internal control is segregation of duties. Different individuals should handle different workload such as issuing, transferring, and cancelling share certificates and no accounting responsibilities. The second would tasks such as maintaining detailed shareholders' records and general ledger control accounts independently. Next is preparation, recording, signing, and mailing of dividend checks to ensure independence. And the fourth is processing cash receipts or disbursements separately from maintaining detailed shareholders' record. For example, the person issuing share certificates should not handle the accounting records, and the person preparing dividend checks should not be the one mailing them. This separation ensures no one person has full control, which helps prevent errors and fraud.
Hi, my name is Norashita Ashifa. So next I will explain about the Independent Share Registrar. So Independent Share Registrar is a company or organization that helps manage the records of shareholders for a company. So their main job is to keep track of who owns shares in the company, how many shares they own, and handle related administrative tasks. So the characteristic of Independent Share Registrar are unbiased and objectivity, accurate record keeping, and also security and confidential. So what is the example of Independent Share Registrar that we have? Boardroom Limited and Trico, Sunway ISS, and the Computer Share M Trustee Berhad. Hi, my name is. Next, I will explain about the audit, capital shares, and pay-in capital. So the first one is completeness, which is verifying that all transactions related to capital share and pay-in capital are recorded. The second one is occurrence and accuracy. Occurrence and accuracy, like ensuring that the transaction actually happened, are recorded correctly. And the next one is accuracy, which is checking that the amounts and details are correct. And the last one is presentation and disclosure, which is making sure that information is properly presented and shared in financial statement. And I will explain about the audit of dividends. So the first one is occurrence. The first occurrence is focused on ensure that recorded dividend is actually happen in the company's operation and there is no fictitious dividend happen. Another occurrence is to confirm that dividends are paid only to shareholders who actually exist and there is no fictitious shareholder. The next one is completeness, which is to ensure that all existing dividends declared by the company are fully recorded in the financial record as expenses. Another one is to verify that all dividends payable to shareholders have been properly recorded under current liability to ensuring no omissions. And the last one is accuracy, to check that the amount of dividends paid or declared match the actual figures without error. And also another one is to ensuring that the amounts of dividend payables are correctly calculated and recorded, avoiding any discrepancy. The last one I will explain about the audit of retained earnings. So retained earning is represent the profit company keep after paying dividend to shareholder. So the auditors will look at the two things that affect this balance. So the first one is net earning for the year, which is the profit of the client made during the year after minus all the expenses. The next one is dividend declare, which is payment made to the shareholders that will reduce the retained earning of the company. The next point is that the possible correction to retained earning, because sometimes a retained earning need to be adjusted due to past mistake or reclassifications. Like the first one is prior period earning. The correction if error were found in previously reported financial. The second one is prior period adjustment for significant mistake or misstatement in financial statement. And the last one is reserve, which is the fund that the company will set aside for a specific purpose. So all of these are important to ensure that the adjustment and transaction are accurate, properly recorded, and compliance with the accounting standards. So that's all from us.